Welcome to the Probate Nation. Probate is the process to settle up the financial affairs of a decedent and transfer the title of probate assets that remain to her beneficiaries. As you travel on your probate journey, you need to know if you must file an estate tax return. You may need to sell some of the probate assets to have cash to pay estate bills. And when you reach the end of the train ride, you may have to have some estate assets other than cash to distribute to the beneficiaries of the estate. In all these situations, it is important to know, as of the date of the decedent's death, the tax basis of all the assets deemed owned by the decedent, regardless of whether those assets go through probate or not. But what is tax basis? Why is it important? And how is it established? These are all good questions, and we're pleased to have as our guest this evening a local CPA. He will serve as our guide and answer these questions and more as we discuss in detail this important tax topic for both the decedent's estate, which you are administering, and the decedent's beneficiaries. Our guest has been a CPA for over 30 years and is currently the managing partner of Dunham, Aucamp & Rhodes, PLC, a public accounting firm located in Chantilly, Virginia. He focuses his practice on tax and accounting for individuals, small businesses, and the trust and estates. In addition, he is a regular speaker before civic and professional organizations on tax planning, retirement, and business topics. Please welcome CPA Michael Aucamp. Hi, Michael.
Hi, Richard. How are you?
Good. Nice to see you again. I appreciate you coming over and having a conversation about this really, important topic, although it might be kind of mind-numbing to some of our viewers who don't really like taxes. But good thing to go over and understand.
Definitely.
So let's talk a little bit at the beginning about what are capital assets?
Well, capital asset is any significant piece of equipment, a property that you own. It's also stocks and bonds. So anything that you own that has a value to it, generally held for appreciation, would be considered a capital asset.
And what is the tax basis of a capital asset? What do we mean by that?
Generally, the tax basis is going to be whatever you paid for the asset originally. In the case of property, it can also include improvements and other things that you put into it over time. And in the case of business assets, you also subtract depreciation that you've taken as an ordinary business deduction on your tax return, and that all comes to your basis within your property.
So, but the key thing, of course, is that tax basis is generally you start with, it's what you paid for it.
That's correct.
That's the key. So what is the tax basis of an asset received by someone as a gift prior to death? So I'm living and I transfer some asset to my son or my daughter. What's the tax basis of that asset?
When you inherit, when you receive something by a gift, you would inherit the tax basis from the person who made that gift to you. So if you had bought a stock for $10 a share and gave it to me, even if it's trading at $100 a share now, it would still be worth $10 in my hand, and I'd be liable for the gain from that $10 to the current value.
Okay, and the gain would be recognized when you actually sold it. And what we're talking about is that there's what's called carryover basis. Correct. So it transfers up. So what is the tax basis of an asset held by a decedent on the date of death of that decedent?
Now, that's one of the unfortunate things. The best way to save taxes is to pass away, because you would receive a stepped-up basis on the date of death from that. Not a strategy you really want to employ, but once it happens, you receive those values of whatever the date of death from the decedent was. So regardless of what they had paid for it, you receive the value on the date that they passed away.
So the example that you just mentioned, if I have a share of stock that I bought for $10, and when I die, it's worth $100, and that passes to my son or daughter, their new tax basis is not the $10 I paid for it, but the $100, which is the fair market value of that stock the day I died.
That's correct. They could turn around and sell it the day after and pay essentially no capital gains on it because they get the value on the day that you passed.
So that's the important thing. So we want to know, why is it important from a tax standpoint, and it's really talking about savings on the tax rates. And when we sell an asset, with a stepped-up basis, we wipe out all that gain.
That's correct. Frequently, when you have especially older people who may have had a stock or a piece of property for a significant amount of time, there's a lot of built-up gain in that. You avoid all the taxation on all of that gain by receiving it through inheritance, after their death.
So what we talked about at this point is the importance and the benefit of holding an asset until you die to get that step up in basis. So let's talk about some of the important estate and gift tax law changes that are now promoting that idea as being a good planning technique. So what is the federal and estate tax gift exemption? It's a big number now. Is it $11-12 million?
Yeah, it's $11.18 million per person.
Okay. So, and then over the last few years, of course, that exemption has risen sharply from where it used to be. Now, there's this new concept that was introduced a few years back called portability. Okay, so explain to our viewers what that means.
Well, what the portability means is, as we said, you have just a little over $11 million per person for your exemption. So typically in a husband-wife arrangement, all of the assets are typically given to the spouse. So if that spouse who passed away first did not use any of their exemption, that $11 million rolls over to the remaining spouse, so they would end up with approximately $22 million that they could have before they could have in assets before they would have a taxable estate.
Okay, so that's, of course, is one of the big changes that occur, because it used to be that we couldn't pass that exemption on to our surviving spouse. And so it really forced folks to try to create a tax in order to use the exemption up. So that's a very important tool now, and that tool then allows the surviving spouse to hold as many assets that they possibly can until the day they die and get that full step-up in basis. What is, let's go, so the key is we want to get the property to a date of death value, which is the fair market value. So let's talk about that. What is fair market value?
Well, the fair market value is generally going to be when you have a willing buyer, a willing seller, and what they would each be willing to accept for a piece of property or for an asset. Mm-hmm. That would generally be considered a fair market value. Okay.
And when is the date that fair market value is established in an estate?
In an estate, you have generally the fair market value is decided on the date of death. So whatever date the decedent passed, that would be the date that you have available, and you would have to value all the assets on that date.
Okay, so there is this concept of what they call an alternate valuation date, which you can use only if it lowers the value of the estate, correct?
That's correct. You can use an alternate valuation date, which is 6 months after the date of death. It's an election you have to make in the estate. However, you have to be careful because you have to make that election for all assets. You can't pick and choose which ones went up or down to your liking. So you would have to determine the 6 months after which made more sense in your particular circumstances.
And generally that was a strategy that could be used in order to lower the estate tax, but given that most states will not have to worry about that, that's generally not something that most people are going to make an election on going forward.
Probably not anymore, no.
How about exceptions to basis step-up? Anything where we wouldn't get the basis step-up?
One of the assets, the biggest assets are typically in a state are retirement assets. Mm-hmm. Retirement assets are funds that have never been taxed. Generally, they come out pre-tax, either through an IRA or through an employee's work. And so those have never been taxed. So the IRS is looking for their tax on those. So retirement assets received in an estate would still be taxable to the beneficiary.
So given that I try to be creative and I want to take advantage of this full step-up, if I own some assets that have a very low tax basis and my dad's getting ready to die, can I give those assets to him and then he give them back to me after he dies to get the full step-up?
Unfortunately, no. The IRS can outsmart you on that. Anything that you have within 1 year of passing and then that you turn around and give back to the person who gave it to you, then you would not be eligible for the step-up on basis. So they're one step ahead of you on that one.
Those tax lawyers are always on top of that stuff. Well, let's talk about basis step-up. What property is subject to a basis step-up at the date of death when someone dies? What kind of property?
Generally, anything owned directly by the decedent would get a stepped up basis. So if you own stock directly or you owned a piece of property directly, all of that would receive a step up basis on your date of death.
And a lot of people have their assets held in a revocable trust. Would those assets get a step up basis too?
Yeah, IRS considers a revocable trust a disregarded entity. So those would be treated as owned directly by the individual, and so those would be eligible for stepped up basis as well.
And then of course, in a lot of estate planning, we've given people, we don't give the people the asset outright, but we give them what's called the general power of appointment. So those assets that are subject to that general power of appointment would also get a step up basis too?
That's correct, yes.
And then I think the last thing would be we have this thing called Q-tip, which is a way to leave money to your surviving spouse. And those assets also get a step up, as I understand it. So let's talk about specific assets now, how we value those. So real property. How is real property valued?
Real property is generally done through an appraisal. If you get a qualified real estate appraisal done for the date of death, then that's going to generally be the value that you would assign to real property.
And you want to get an appraiser. Okay, I think the big thing is we don't want to go to and rely upon tax assessed values. An appraiser really is important to make sure you get the appropriate valuation.
Right, IRS would not accept the value of the county assessments or any other anecdotal information like that. To really be able to justify what you've used for that value, you would need a qualified appraisal on that.
Okay. How about brokerage accounts? How are they valued?
Brokerage accounts are pretty easy. You just use the U.S. stock market value on the date of death, and that is the step up on date of death on that.
I just anecdotally, as a practical matter on the brokerage accounts, we always tell clients to make sure they have the brokerage office house update the date of the cost basis of the assets that are on the brokerage statement to the date of death value, because if you don't, then when they're sold, they're going to produce 1099s based on the old cost base, which is not correct anymore. How about closely held business interests like C Corps, LLC, membership, partnerships, sole proprietorship? How are those valued? Talk a little bit about those.
Well, generally, those types of businesses are not publicly traded, so therefore you'd need a qualified business valuation performed on those. Business valuation is going to look at cash flows, the value of assets within the business, but then they're also going to look at other things such as marketability discounts and lack of control, that just because you own 30% of a stock in a company does not necessarily mean you have 30% of the control. Because you have less than 50%, your value, your 30% may be actually worth less than 30% of the total value when you do a business appraisal.
So just so our viewers know, valuing businesses is a complex area, and reasonable folks can disagree markedly as far as what something is worth. But it's something you definitely want to rely on that, at least as a beginning point. What if a lot of people own investment properties like a rental property in an LLC? Okay, what happens to that to the property in the LLC?
Well, the property in the LLC does not receive the step up in basis. The step up in basis is in your value of the partnership interest in that property. So it would just be when you sell it eventually that you would get the value of the stepped up in basis against what was also ultimately sold.
Okay. Let's talk about retirement accounts. You mentioned a little bit, but how are those valued?
Retirement accounts generally valued, essentially, they're done through brokerage accounts typically, so it's whatever the value is through the brokerage company on the day of death.
Okay, but we don't get any sort of step up as far as the inside assets in the account itself.
No.
Okay. What else do we have here? Let's talk about annuities. How are these valued?
Annuities, similar to regular investments, are all going to be valued on the date of death. Typically, there's going to be a death value stated in the annuity contract, and the investment company would be able to tell you what that is at that time.
Okay. Okay. Well, there's a bunch of unique kind of assets that we ought to talk about that people see on a regular basis. So, jointly held property between spouses. How is that valued?
When you hold a property directly with your spouse, you do receive a step up in basis for 50% of that when that person passes away. So if my wife has a piece of property jointly with me, maybe we purchased for $200,000. Our basis would be $100,000 each. If on the day she passes, the value in that property is $1 million, we would each half would be about $500,000. So she would get the stepped up of basis of $500,000 plus the $100,000 for my half, and we'd have a $600,000 stepped up on basis for that.
Okay. So as far as husband and wife, the step up in base only applies to half of the ownership interest that the spouse has who has passed away. And it doesn't matter how much money either spouse put into the transaction from a tax standpoint. We just assume that they each put in half.
That's correct.
Okay. So how about jointly held property between non-spouses, say a father and a son. How is that handled from a basis and standpoint?
Now that's going to be slightly different. You can get a stepped up on basis of it, but there is a rule where they're going to look at the value of what you put into the business. So you're only going to get a stepped up on basis to the percentage that the decedent put into that business. So sometimes you have, you mentioned a father and a son, so it may be a place where one of them put everything into it but gifted half of it to there, then they would only get a stepped up basis of the amount that they put into it and that percentage.
Mm-hmm. So if Dad put in 100%, then we would get 100% step up in basis?
That's correct.
Okay, and that's important to know. Okay, so how about assets held inside a business that are operated by a C Corp or an S Corp? Do they get a step-up in basis?
No, there's going to be no stepped-up basis on those types of assets.
Okay. How about assets held inside a single-member LLC?
Again, a single-member LLC is a disregarded entity, so those are treated as owned directly by the decedent, so those would be eligible for stepped-up in basis.
Now, a lot of folks do own, rental property where and husband and wife are treated like one owner will own in a LLC. So I think that's a very common thing. Now, how about assets inside of a partnership? There's some unique rules there that might apply with respect to basis of the inside asset inside the partnership. Can you talk about that?
Yeah, there are some elections that you can make where you can elect a step up in basis of an asset within a partnership, subject to certain rules with that. But there are some things that you can get and elect a stepped up in basis for the decedent share.
Okay, and then finally, sole proprietorship. If I have a business that I'm running as a sole proprietor, it's reported as a Schedule C, it's not an LLC. What do we do with that? How do we value that?
Again, the business portion of that, you would need a business valuation to establish the value on that. Any of the assets inside would get a stepped up in basis, again, because that's treated as owned by the decedent. Okay,
so let's talk about revocable trust. I mean, I think that's something that a lot of people do. I mean, I do it. I know, a lot of your clients do it. And they put the house in the revocable trust. They put, husband and wife a lot of times now are doing joint trust, so they're putting all in one trust, okay? The assets, may have been owned by one spouse or the other, but they all go into a big pot. Then one of the spouses dies. What do we do with all those assets inside that revocable trust? How are they valued?
Everything in the revocable trust, since it is revocable, the IRS doesn't deem it a viable entity, so that's going to be treated just the same way as if it was owned directly by the decedent, and you would be eligible for a stepped-up basis on those assets.
And those assets would be stepped up. If I'm married, I'd get a 50%
50%
step. If I'm single or I'm a widow or widower, then it gets 100%.
100%.
Okay, and that's important to know. So Michael, apart from the revocable trust, which generally is disregarded from the tax standpoint, we have a lot of folks that have irrevocable trusts that have been created by parents or grandparents. And they may give a surviving child or a surviving grandchild, the case may be, certain powers to dispose of the assets in that trust, either during lifetime or at death. The IRS defines those powers, and one of the things they talk about is if it's a special power, so it's very limited as to who it can go to, and generally it's to heirs down the line as far as inheritance, and not to the person who holds the power. So I believe when we talked about preparing for the show, the assets inside that kind of irrevocable trust do not get a step up in basis. Is that your understanding?
Yes, that's correct.
Okay.
Yes.
Okay, let's talk about basis consistency. One of our challenges, of course, is making sure that everybody understands how do the tax authorities know what is the tax basis of any asset inherited by someone, either through probate or by operation of law? How do they know what the tax basis is?
Well, first of all, if you have a taxable state, you have to file Form 706 on a state tax return, and included in that is a listing of all of the assets in the estate. So there would be one way. Also, there's the Form 8971, which is specific assets handed down to beneficiaries. It's the way you can alert through that form to the beneficiaries to the fair market value of the assets that you've received through that distribution.
Okay, so Form 8971 is really a way to, the purpose behind that I think is to actually pass on to tell the IRS what the tax basis is of the asset I've handed off to somebody who inherited that, and also a way to tell the person who received that asset what their tax basis is. Is that correct?
Exactly, yes.
Okay. But it only has to be, does Form 8971 have to be filed for everybody in every situation?
No, it's only filed when you file the Form 706, the estate tax return.
And but it doesn't apply when you file a 706 solely for the purpose of claiming the portability, right? It's just if you actually have a taxable estate and you're going to pay taxes.
That's correct, yes.
Okay, so that would be in the second estate typically of a husband and wife, where they actually had at this point more than $22 million of assets, where they might actually have a taxable estate.
Yes.
So at this point, it seems like Form 8971 is not particularly relevant to most people. Do you think that's going to change though?
I would think so. The IRS is going to more with transparency. You know, a few years ago when they increased the requirements on investment companies to report basis.
Oh,
you know,
yes.
Up till then, you just put whatever you wanted, and unless you were audited, no one ever knew any different. Now they're really required to do that. So I would think, you know, it's very common to receive things through an estate, so it is definitely something that they could require that wouldn't be too onerous, and then have those assets definitely marketed at value.
And certainly if Congress was to amend the exemption amount to bring it down from 11 million plus and bring it down to $3, $4, $5 million where it was several years back, that could cause more and more folks to have taxable estates when the second spouse dies. Now, in the meantime though, if I'm not required to file Form 8971 to let the IRS know and the beneficiary know, what should I as an administrator or an executive be doing in the way of information I should be giving to that heir who inherits a piece of real estate or some stocks or bonds or whatever from someone who's passed away? What should I give them?
Well, it's really important that you take care of your duties as administrator, so you'll get that business valuation on closely held businesses. You get the appraisals on property owned, and you work with the investment companies and the value of all that. When you gather all that information, whether you're required to file the tax return or not, you have that information to be able to pass to the beneficiary so that they're able to make important tax decisions going forward as far as what to do and how to handle those assets.
So as a beneficiary, I need to be diligent about asking that executive to make sure they give me that information, if in fact they give me anything other than cash as my inheritance.
Yes.
Is that true? Okay, well, this has been a lot of information. Of course, it's extraordinarily important because, you know, nothing's more frustrating when you get that call from your CPA saying, do you have any information to support the tax basis for this asset you just sold? And the beneficiary goes, I don't know. And it's 10 years since the estate was closed. So anyway, can you share some final thoughts or words of advice on what we just discussed this evening?
Sure. I mean, I think when a loved one passes away, you have so many more important things to deal with at that time. But when you're able to get around to taking care of those tasks as administrator of the estate or anything, it's very important to make sure you collect all of those assets and list everything, get all those valuation for all those assets together so that you can pass it down to the beneficiaries. It's going to be important for them when they sell those assets later. So you definitely need to keep in contact with those beneficiaries, make sure they understand what's coming through, and understanding especially with retirement accounts, how that is treated differently than other assets. That's the most common thing that I get when someone calls and says their parents died, what do I do? They're frankly surprised when I tell them there's no tax on most of the estate. It's only going to be on the retirement accounts. So it's definitely important to educate those beneficiaries as far as what's going to happen and take care of your duties as trustee, administrator of the estate.
Michael, thank you so very much for coming in and sharing all this information. There's just so much tax knowledge sitting across from me. I appreciate you coming in and sharing that with us. And for our viewers, I mean, I think this is something that's going to be helpful to folks that are administering estates by themselves, and certainly for beneficiaries so they ask the right questions when they receive an asset in the course of an estate administration. So thanks again.
Thank you for having me.
You're very welcome. As you administer an estate of a loved one, you need to know if you must file an estate tax return, or you may need to sell some of the assets in order to have cash to pay estate bills. or you may distribute some assets to beneficiaries of the estate rather than selling those assets. In all these situations, you need to know the tax basis of the assets, which is the fair market value of those assets at date of death. And keep in mind that the IRS does have some reporting requirements regarding the tax basis of assets that may be relevant to your situation. Guessing or approximating value or relying on local tax assessments in the case of real estate is not recommended. Use appropriate professionals to establish the date of death value and report same to the tax authorities. And if you distribute assets like stocks and bonds or real estate or closely held business interests to a beneficiary, be sure to give them the information and supporting documentation for the tax basis of the assets they just inherited. The beneficiary and all the CPAs involved in reporting the sale of those assets in the years thereafter will be grateful to you for doing so. This brings us to the conclusion of our show tonight. We hope you found it helpful. Replays of this show and all the shows broadcast to date, along with other helpful information, can be viewed on the Probate Nation website. On behalf of the Probate Nation, thank you for visiting with us.